Well, welcome back, everyone. It's really nice to have so many of you joining us today. It's really a great pleasure for me to introduce a good friend and former colleague as our keynote speaker for this year's conference. As is our tradition, one requirement is to have someone who combines impeccable academic research credentials with great policy relevance. And you will all agree that Sharon Kozicki fits this description perfectly well. Sharon got her PhD at the UCSD and then launched her career by joining the Fed, first at the Board of Governors and then in Kansas City. And in many respects, these were banner years in the Fed system. And other work done in the mid to late 1990s became the basis for understanding how the economy works in monetary policy in a low rates environment. Work, for instance, at the zero lower bound, quantitative easing, and R-stars. Now, one early paper by Sharon at the time was on shifting endpoints that are embedded in economic forecasts. And so that seems to be a pretty technical point. It became really influential and useful in capturing the decline in estimates of R-stars in finance models, for instance, as work by Michael Bauer and Glenn Ritterbush here at the San Francisco Fed, as shown. More broadly, Sharon is simply an outstanding macroeconomist. Her empirical skills have really been an invaluable asset for the Bank of Canada in guiding the forecast and the policy analysis. And in fact, a few years ago, I remember that Bloomberg put out a piece comparing the forecast accuracy of major central banks, and the Bank of Canada came up on top with the most precise forecast. And that's a hard forecast to do since the Canadian economy depends on the world economy and commodity prices. And so it's easy to be wrong, but the bank's success, I think, owes a lot to Sharon and her guidance and mentoring of the staff. Now, Sharon, I'm absolutely delighted that you decided to give your first speech as a deputy governor here at the San Francisco Fed. And I know from experience that this can be a stressful step, but we will send you all the positive West Coast energy that we can find. And please remember, no more shifting endpoints in your forecast. Inflation always go back to 2%. Always, period. Please take it away. Thank you.
Well, thank you, Sylvain, for the kind introduction. I have many fond memories of my time at the Federal Reserve Board and at the Kansas City Fed. And as some of you know, I've actually given talks and attended conferences at the San Francisco Fed several times. I'm honored to deliver the keynote today, and I look forward to being there in person again soon. Before continuing, I'd like to acknowledge that the land I'm speaking from is traditional unceded territory of the Algonquin Anishinaabe people. I'd also like to acknowledge the profound suffering caused by Russia's unprovoked invasion of Ukraine, and the particularly anxious time this continues to be for those with family and friends in Ukraine. Since the situation remains fluid, my governing council colleagues and I are following events closely and assessing the ongoing impact, economic impact, and financial impacts. So like other central banks, the Bank of Canada sets monetary policy for the whole economy. But that doesn't mean our policy affects everyone in the economy the same way. And it doesn't mean our policy has the same impact on the economy overall, regardless of the characteristics and circumstances of the people in it. So today, I'll explain how differences in income, wealth, and debt across households matter for the economy, how shocks can have important uneven effects across households, and why these matter for monetary policy. I'll also discuss the uneven impact of the COVID-19 pandemic on households, including how their finances have evolved over the past 2 years and the added challenge of high inflation. As well, I'll say a few words about how our recently renewed monetary policy framework addresses household differences. Before closing, I'll talk about the current stance of monetary policy, because bringing inflation back down to our 2% target will require higher interest rates. Before I start, I want to be clear about two concepts I'll be talking about that are related but distinct from one another. The first is heterogeneity, which refers to the different characteristics that distinguish people or households, such as age, gender, race, occupation, industry, income, and wealth. The second is unevenness, which refers to the fact that when shocks hit the economy, their impacts differ across households, and in many cases, for reasons linked to those same characteristics. With all that in mind, let me begin. So a key way that monetary policy influences economic activity is through its impact on household spending. Traditionally, for central bankers and other researchers, this has implied a focus on consumption, disposable income, and other macro data. Some economic models split households into two groups of fixed size. In one group, spending is constrained by income, while in the other group, it isn't constrained in this way. In other words, people in that second group can make savings versus spending decisions with an eye to future needs and wants. Most other distinctions, however, often weren't seen as important for monetary policy. But research has come a long way over the years. Today's economists are increasingly able to draw on micro data from households and on an ever-expanding arsenal of analytical techniques and models. In doing so, they've found that differences in income, assets, and debt across households matter quite a bit for the economy and for the health of the financial system. They've also found that these differences evolve over time. And if these things matter for the economy and financial system, they matter for monetary policy too. So recognizing this, the bank has done a lot of work to better understand the range of household experiences in the Canadian economy. We've created the Heterogeneity Lab, or HET Lab for short. It's a place where economists, data scientists, and other researchers work together on projects, much as they would in a science lab. And we've done a lot of thinking about how some of the key differences across households should factor into our policy decisions. The lessons we've learned from digging into microdata have been vital to the bank's understanding of a host of issues around the labor market, household spending, and debt. Our understanding of these issues informs both the setting of monetary policy and our assessment of household vulnerabilities and risks to the financial system. So before I discuss the uneven impacts of the pandemic, let me expand on why household heterogeneity matters, especially when a shock hits the economy. It's mainly because people are exposed to recessions in different ways and to different degrees. For example, because of the type of work they have or the industry they work in. And differences in how people experience a shock can amplify its effects, as well as the impact of fiscal and monetary policy responses. Low-income workers, for instance, are more likely than high-income workers to lose their jobs in a downturn. Thus, income inequality typically rises in recessions. Low-income workers also tend to consume more of their income on average. So when a negative shock hits the economy, consumption by low-income people is more likely to fall, and to fall proportionately more. The drop in overall demand causes businesses to cut production, which results in more job losses and deepens the downturn. This type of amplification of the initial shock is what we commonly refer to as a multiplier effect. In addition, when people feel less secure about their prospects, they tend to boost precautionary savings if they can. The drop in demand from that behavior adds to the multiplier effect. Now, fiscal and monetary policy responses can break that chain and cut the length and depth of recessions. Fiscal policy can help stabilize household spending during a downturn through measures such as employment insurance or wage subsidies that ensure people still have some cash coming in. This limits the overall drop in demand, making it easier for businesses to retain staff and reducing the severity of the recession. Similarly, by making it less expensive to borrow, monetary policy encourages some households to pull forward some of their spending. At the bank, while we've invested for years in our ability to examine household differences and economic developments at a granular level, this work really intensified with the pandemic. And it has paid dividends in helping guide our policy response. The uneven impact of the pandemic on employment is a familiar story, so I won't go into much detail. Most people who could work from home kept their jobs, and saw little or no interruption to their income. Meanwhile, measures to contain the virus hit some services, such as restaurants, accommodation, travel, and entertainment, especially hard. And many people in these sectors lost their regular sources of income. The impact was most severe for low-wage workers, especially women and young people, with childcare challenges exacerbating the situation for many women. The extreme size and unevenness of the effects and high uncertainty about how long they might persist led to strong policy responses. I won't go into much detail here either, but in Canada, as in the United States and other major economies, the responses were both rapid and intentionally massive. In Canada, the federal government introduced a range of emergency support measures for households and businesses. Monetary policy also played a critical role. The bank lowered its policy interest rate to the effective lower bound of 0.25%. And we said we'd keep it there until slack in the economy was fully absorbed. For the first time, we also undertook quantitative easing. We purchased large quantities of Government of Canada bonds to put further downward pressure on borrowing costs for households and businesses. As well, recognizing the importance of household heterogeneity and the uneven impacts of the pandemic, we expanded the set of labor market indicators that we look at. This allows us to track outcomes for different demographic and income groups, giving us a more complete picture of the economy. In fact, the labor market has recovered from the effects caused by the pandemic. The uneven impacts have also largely unwound. For example, the pandemic-induced gaps between employment outcomes for women and youth versus other groups have dissipated. I should point out that no effort to track the progress of different groups of workers or households will ever capture everyone's circumstances. Even with all the policy support, the pandemic has been challenging for many households, and some still face hardship. In Canada, the fiscal benefits for affected individuals were of a fixed amount. That means they more than replaced lost wage income for some low-income households, but they fell short for others with higher incomes. Plus, income support doesn't replace the experience gained while employed or the long-term benefits of staying in the workforce. Also, loan deferrals during the pandemic were helpful and have expired without a rise in delinquencies, but those deferrals didn't reduce debt. They just delayed service payments. All that being said, despite the impact of the pandemic on employment, several factors have cushioned the impact on household balance sheets. A big one was the fiscal transfers, and helped contribute to a large buildup of household savings. Also contributing to this was lower consumer spending, largely due to pandemic containment measures and the uncertainty and caution that continue to weigh on many. A lot of the savings are still in personal bank accounts. Bank deposits have grown by an average of around $12,000 per household compared with pre-pandemic trends. Another important factor helping balance sheets was that many households in Canada took the opportunity to pay down high interest debt, such as credit card balances. In fact, the declines were largest for people with low credit scores who tended to be younger and have lower incomes. The number of households borrowing against their homes has also declined, which suggests many are resisting taking on more debt to fund purchases. The decline is unusual for a period of rapid gains in house prices, like what we've seen over the pandemic. Some households have also opted to pay down their mortgages faster. Now, early in the pandemic, higher savings and lower mortgage rates made it easier for some people to buy homes. These new homeowners and existing ones then watched the value of their homes soar as a surge in demand outpaced supply. By spring 2021, prices had risen sharply enough that issues around housing affordability became a prominent national concern, and that is still the case. Even with mortgage rates lower than before the pandemic, it's been particularly hard for many first-time home buyers to get into the market. Another important development affecting household balance sheets was the substantial rise in many stock markets during 2020 and 2021. Overall, despite the large and uneven shock that hit them 2 years ago, households across 5 groups, sorted by income, appear on average to be in healthier financial positions than before the pandemic. Indeed, the share of Canadians falling behind on consumer debt payments is close to its historic low, and credit scores have generally risen. Also, fewer households are living paycheck to paycheck. Regardless, the pandemic and the related lingering uncertainty, combined with the challenge of high inflation and Russia's invasion of Ukraine, are causing many people to feel anxious. The bank has been clear that higher interest rates are needed to bring inflation sustainably back to the 2% level. So now let me discuss a few factors particular to households that will be relevant as we proceed with this phase of tightening monetary policy. One is that while rising interest rates will have an immediate impact on new home buyers, they'll have a more gradual impact across existing homeowners. This is because increases pass through only gradually to the pool of existing homeowners. Almost 3/4 of mortgage holders in Canada have fixed rates. Most of them are on 5-year terms, so in a typical year, only about 20% have to renew. And people renewing over the next couple of years will likely get rates that are similar to what they're paying now. This is because increases to our policy interest rate about 5 years ago were offset by decreases in 2020 after the pandemic struck. As well, most variable rate mortgages have fixed payments. In addition, as I noted earlier, a lot of households paid down principal during the pandemic. When rates fell, households on variable rate mortgages with fixed payments paid down extra principal. Meanwhile, some with fixed rate mortgages prepaid by setting higher regular payments or through lump sums. As a result, many households have more financial flexibility now. Some developments have been worrisome. While household indebtedness initially improved earlier in the pandemic, it has since risen above pre-pandemic levels, and its elevated level remains an important domestic vulnerability. High indebtedness could amplify the impact of rising interest rates, and it could also worsen the impact of a future shock. For example, the rapid rise in house prices during the pandemic has led to an increasing share of households taking out new mortgages that are large relative to income. And a growing share of these mortgages have variable rates. Moreover, the households that have taken out mortgages with high loan-to-income ratios probably aren't the ones who still have a lot of cash in their bank accounts. Some of these borrowers may be expecting their future income to rise. But it's also possible that rising mortgage rates will weigh on their spending. And if enough of them were to slow their spending materially, it could affect the whole economy, such as by slowing growth or increasing unemployment. A drop in house prices could worsen these effects. Adding it all up, though, we see that households on average appear to be in better financial shape now than at the start of our 2017 to 2018 tightening cycle. As we proceed with policy tightening, our rich data capabilities will continue to pay dividends. That's because they give us a more refined lens into how households are responding to our monetary policy. So now let me tell you about the recent renewal of the bank's monetary policy framework and how it addresses heterogeneity and unevenness. So our agreement with the Government of Canada is renewed every 5 years. This process is highly valuable to us, just as the Federal Reserve's own renewal process is to you. Particularly because our process gives us an opportunity to consult widely. Unlike the Fed, which has a dual inflation and employment mandate, the bank has a primary objective of low and stable inflation. And this is reaffirmed in our latest agreement from last December. The renewed agreement also articulates more clearly the role that the labor market plays in our framework. In particular, it emphasizes that low, stable inflation and maximum sustainable employment go hand in hand. and it recognizes that when the benefits of growth and opportunity are shared more evenly, they lead to more prosperity overall. In practice, it commits us to monitoring a broad set of labor market indicators and to explaining to Canadians how labor market outcomes factor into our policy decisions. Now, tracking a range of labor data is important because it's hard to know when maximum employment has been reached. In part, it's because our estimates of it are highly uncertain. And when inflation is below our target, so that's unlike today, we want to avoid tightening prematurely so that we can achieve maximum employment and get inflation sustainably back to target. Now, research has shown us that when accounting for heterogeneity, the gains and losses from tightening policy too early versus too late aren't balanced. The people who tend to bear the brunt of recessions also tend to take longer to benefit from recoveries. So tightening too early doesn't only risk delaying their return to work as the economy recovers. It also risks depressing their participation in the labor force for long after, and as a result, can entrench long-lasting inequality. Now, the Fed recognized this risk during its tightening cycle from 2015 to 2018 by taking a cautious approach that promoted a more inclusive labor market recovery. Feedback from Fed Listens events in 2019 reinforced the importance of sustaining the economic expansion. Many people who had trouble finding work eventually benefited from the strong job market. For today, I'd just like to reinforce that our renewed agreement commits us to using a wide variety of data to assess what's going on in the economy. And I'll remind you that the current context is one of high inflation. So let me say a few words now about our policy stance. With slack in the economy absorbed, we raised our policy rate to 0.5% in early March. And we also said we expect it will need to rise further. We also said that we'll be considering when to begin to allow the bank's holdings of Government of Canada bonds to shrink, a process known as quantitative tightening, or QT. We were clear that the timing and pace of further increases in the policy rate and the start of QT will be guided by the bank's ongoing assessment of the economy and its commitment to achieving the 2% target. I expect the pace and magnitude of interest rate increases and the start of QT to be active parts of our deliberations at our next decision in April. The reasons are straightforward. Inflation in Canada is too high. Labor markets are tight, and there's considerable momentum in demand. Now, with everyday items such as gas and groceries facing some of the fastest price gains, all households are affected by high inflation. But my colleagues and I are mindful that this is especially painful for those with low incomes, because they tend to spend a greater share of their earnings on such items. The impact could really add up. For a household that spends $2,000 each month, an increase in total inflation of 3 to 4 percentage points could add $60 to $80 in monthly expenses, or up to about $1,000 a year. The invasion of Ukraine is adding to inflationary pressures around the world and in Canada. This is primarily because it has caused global prices for oil and other commodities to surge. The result is inflation in the near term is expected to be higher than we projected in January. That's when we published our latest projections. A key concern for us is the broadening of price pressures. Around 2/3 of the components in the Consumer Price Index are now exhibiting inflation above 3%. Persistently elevated inflation increases the risk that longer-run inflation expectations could drift upward. So while we will watch developments with respect to households closely as we proceed, it's important to be clear. Returning inflation to the 2% target is our primary focus and our unwavering commitment. We have taken action and will continue to do so to return inflation to target, and we're prepared to act forcefully. So to conclude, let me recap the main messages I want to leave you with. The pandemic had large and uneven effects on employment. That made it all the more urgent to understand how differences among households affect economic outcomes, the health of the financial system, and the transmission of monetary policy. We've been intensifying our efforts using new ways to collect and analyze data, digging into the experiences of a wide range of households and businesses, as well as examining national figures. These tools have shown their worth in tracking economic developments through the pandemic. Now employment has recovered and labor market conditions are increasingly tight. And although household debt is still elevated, policy supports and increased savings have helped bolster households' financial positions across income groups. Our primary concern is high inflation. The bank will use its monetary policy tools to return inflation to the 2% target and to keep inflation expectations well anchored. We will be closely monitoring the data and communicating clearly to Canadians every step of the way. Thank you.
Thank you, Sharon. Thank you for this and the additional information on the framework. I will take comments from the floor, but maybe one first question could go on labor markets. It's quite astonishing to see the recovery in the Canadian labor market, particularly you noted employment, but also labor force participation. And this is something that has been a bit lagging in the US. In particular, labor force participation has really stagnated over the past year or so. I was wondering if there's anything particular to the Canadian experience that has kind of favored a quicker and fuller labor market recovery.
Yeah, so certainly things are different in Canada and the United States. And one thing that we were monitoring through the pandemic was the difference between the number of hours per week that workers were working in the United States versus Canada versus the number of people who were actually working. And it was interesting that in Canada, hours stayed lower while employment picked up. In the United States, hours picked up faster and employment was lagging. So there was a difference in the composition. So that one thing I think was quite interesting to see. So now we have recovered in almost all of the metrics, employment rates, et cetera, in Canada. But things were also different in Canada, and for a variety of reasons. And perhaps this is one of the reasons that labor force participation has differed across the two countries. In Canada, we have had mandates, not always popular by some groups, but at the same time that have given people who have had to go to jobs a little bit more comfort. And so it's possible just that cautionary feeling for workers has been different. And some people may have felt that, okay, there are more distancing types of restrictions. There are more mask mandates. There are other policies such as that many of our provincial governments had imposed that would have helped workers feel a little bit more safe in a pandemic in their workplaces. So I'm not saying that is the driver, but I think it is something that has given workers a little bit more comfort at times in terms of returning to the office. There is one group in terms of labor force participation in Canada that has not yet recovered. It's actually the 55-plus male worker group, which is just probably a different demographic story going on there.
Are there any questions from participants? Please raise your hand so I can see it, because otherwise I can't quite see the. Nicola Petrosky-Nadeau has a question.
Yes, good afternoon in Ottawa, and thank you so much for delivering the keynote address. There's several things that caught our attention and we wanted to ask about, but I think the first one is going again on the theme of the labor market. I was wondering if you could tell us a little bit more the ways in which the new attention to full employment and attaining it in a broad and inclusive sense has factored into deliberations at the Bank of Canada in setting the stance of policy.
So one thing I think that is a little bit different in the history in Canada versus the United States in our communications, again, we have had a inflation targeting without having a dual mandate. And traditionally, we did a lot of communications that were more on an output gap concept of slack. We have increasingly, this predates the pandemic, but we have increasingly been, talking more about things in terms of labor market. And that's partly, frankly, let's face it, a lot of people in Canada have no concept of what an output gap means, right? But people understand jobs, they understand wages, they understand unemployment. And so it makes, in terms of communication, it increases our ability to communicate with Canadians. In terms of looking at things, we have, again, over time, gradually been tracking more and different indicators. Prior to the pandemic, we were looking at long-term unemployed to get a sense of, again, we were in a lower inflation environment and thinking about, were some of these workers that were actually interested in getting drawn back into the labor force and not wanting to short-circuit that. Through the pandemic, I would say, it just became really important to look at a lot of different indicators. And we have something we refer to as a flower chart. As you know, as all economists know, any one measure is going to miss various dimensions. Our flower chart has a lot of dimensions. But what it does do is it provides us a way, and again, it was designed for recovery in labor market, but provides us a way to get a quick snapshot by looking at it quickly to see how many indicators are back to where they were in 2019 and how many are lagging. And it just gave us a much richer picture of what was happening in the labor market. And I'd say that has been really important for our understanding, because at times, again, we would see data that was very strong in some places in the labor market and yet weak in others. That's a really different world than where everyone has gone back to a normal state. It's more like, sort of idiosyncrasies, and that's not the right word, but, some places being under high pressure versus everything back to normal. You might end up having the two things look on average the same, but in reality they're different. And again, this is sort of underlying the speech. When it's a few areas where there's particularly, say, high demand and shortages, that's not necessarily the picture of the aggregate economy. So it's been really important for us to get that richer detail so that we can understand what's happening. I'll be honest, I think it also has helped us in understanding what's happening, even on wage-type measures. We had huge mix effects going on. What do I mean by mix effects? I mean, we had wage measures that were going really high, not because wages were going up, but because job losses were in low income and low wage areas. And so understanding what was driving some of that was very important. So those are some of the areas in which this additional richness on the data has really mattered.
Okay, great. I've got a question from Mary Amidi.
Hi, thank you. As we all know, the issues that the central bank is becoming interested in has been growing over the years in terms of inequality, climate change, etc. And you hear a lot of people arguing that that's not what the central bank should be doing, because our instruments are just too blunt, and those kind of things should be left to fiscal policy, etc. So my first question is just ask you how you would respond to those arguments. And then second, given that we do want to look at, we are concerned about the impact of our policies on inequality. We do have that the same policy is going to affect different groups in different ways, as you've outlined. And then you have the issue where say a very tight market can help low-skilled, low-income people, but at the same time that they may suffer more inflation than other sectors. So you have other groups in the economy. So you have those kind of the usual trade-offs that we we're facing that may be heightened even more for various groups. So I was also interested to hear your thoughts about, like what weight we should put on these kind of opposing effects that are affecting kind of the more disadvantaged groups in the economy.
Okay, thank you. Yeah, this could be a really long answer and a speech in its own. So let me try to just touch on a few points. I think one of the important points, again, in terms of inequality, right? So there's that cyclical aspect that if recessions are disproportionately hitting a group of people, then things that monetary policy can do to reduce the depth and the persistence ends up helping inequality in that dimension. So that's one observation. I think a second observation, though, on inequality is that it does become very important to distinguish between aggregate numbers that might look the same versus different drivers. And those drivers at times can matter. And so the example that I gave in the last question of, if wages are going up a lot, but it's just because of who's losing their job, right, then that's a really different issue than if wages are going up because everyone's wages are rising, right? So that's the sense in which looking into the micro data matters actually for the macro economy and for setting monetary policy. I think going on to climate change, again, the Bank of Canada, in thinking about climate change, we're not going to be instituting policies at a federal level that are going to be trying to somehow influence directly things in that world. But what we do need to do is we need to realize that climate change is a risk, and it's going to be a risk within financial markets if it's not adequately and appropriately priced. Right, so earlier this year, we published some work where we were laying out scenarios specific to the Canadian economy. This was something we did jointly with the Federal Supervisor of Financial Institutions in Canada, and also with a number of financial institutions themselves to work through scenarios to help prepare firms to be better able to assess the impact of climate and climate risks on their balance sheet. Right? And so why does that matter? Well, as a central bank, we're not just setting monetary policy, but we're concerned about financial stability. And so we want to be, flagging the importance of, to financial institutions and other financial institutions of thinking of those sorts of things. And I'll go further. It could be, right now, the big one is going to be climate change, but we're used to more generally thinking of structural change and what that can mean for an economy. And again, structural change can come with people moving across jobs, and it can also, just even independent of that, big shifts in industries. I'll be frank, this is something Canada's seen quite a bit of over the years because our energy sector is a pretty fair-sized chunk of our economy. When prices are really low versus when prices are really high, that maps into implications for the aggregate Canadian data quite a bit. So we are, and we have over time, monitored a lot what goes on because that one industry, again, what's happening in global markets for energy, can have an impact on the structure of the Canadian economy, right? As we think of climate change, similar issues. There are likely to be structural changes in the economy. And so ultimately for monetary policy, we need to understand and think about what the Canadian economy is going to look like along the way. And as we're developing more of a baseline for thinking of what things might look like, once we have that, we're in a better place to think about, well, what if at times things aren't smooth, right? What happens if some adjustments happen faster than others? Well, once we have a sense of maybe, not anticipating those, just in what the end game might look like, then we can start thinking a little bit more about those higher frequency, what if things aren't smooth scenarios. So those are all a whole bunch of different examples, but what I'm trying to say is, ultimately, at the central bank, it's setting monetary policy really requires a good understanding of the macroeconomy and what's driving that, and that includes structural change. And from the financial system side, we want to make sure that, firms, banks are taking account of risks in terms of what their portfolios look like and how, the risks they're exposed to. We just want to make sure that they're adequately thinking about those risks and planning accordingly.
Great, thanks, Sharon. We have another question from Michael McMahon. Michael, can you unmute yourself?
Yep, hopefully you can hear me. Thanks, Sharon, very interesting talk. You mentioned one thing which is close to my heart, which is communicating widely, and this idea of using employment as the basis rather than say output gaps is part of that. But a large part of your talk was also about the sort of the heterogeneity and the nuance of the effects of monetary policy. So I wondered how much you've been able to give thought to the difficulties of communicating both widely, but also not losing credibility by sort of convincing people that, a rise in interest rate will get inflation under control, but for some households it won't be enough, and they'll sort of maybe think you haven't done enough for them. So, it's obviously a difficult thing, both a lot of uncertainty, but also the heterogeneity and the nuance, but also communicating widely.
Yeah, and this is a challenge, right? We set monetary policy for the Canadian economy ultimately, right? And we've identified the consumer price index as the measure of inflation we're targeting. Different regions, different household types, different demographics, all sorts of things will ultimately impact, a household-specific rate of inflation, if you will. And so, there's no way we can try and get the inflation rate every single household is facing down to 2, right? We're aiming to do the economy-wide measure. And I think that has worked well historically in Canada. And the reason I say that is, there is a lot of confidence and there is a lot of awareness of this 2% number. And that shows up, it could be when we're talking, to some consumers, but it also shows up among different groups, talking to firms, talking to labor unions, talking to, all sorts of specialized groups that, this 2% number really does, help them, get anchored in a way. I think the other thing we've tried to do to make sure people, appreciate that we're not only looking at those aggregate numbers is we do try to provide some of the background analysis that we're doing in looking at some of the disaggregated stuff. One of the things that I'll point to just as an example, our monetary policy report back in July of 2018 had a nice little box where we had 4 or 5 different groups, separated across, I believe it was debt. We were looking at debt service ratios. And we wanted to know, if households were faced with an increase in interest rates of this amount, how might it affect their ability to continue to pay their mortgage? So we looked at it for different groups, and not surprisingly, households that had higher, debt to income levels were hit more in terms of share of income by a 1 percentage point increase versus others. But my point here is we tried to show that we showed that exercise inside our monetary policy report because we wanted to understand. We were really trying to think through what might happen to aggregate consumption. We can't just look at a model that averages through everything because there's so much complexity going on. And that one example was just one way we could do to say, okay, let's take a few examples, baseline assumptions here, but let's look at how things might change. And so it was a bit of a snapshot, if you will, into some of our behind-the-scenes analysis where, more household type experiences do feed into our thinking. The other place that you'll see a lot of the time some of the micro analysis showing up is in our financial system review. So in our financial system review, we're often looking at the household sector, because we have concerns about vulnerabilities in the household sector related to debt. We always have concerns about what could happen if types of scenarios. And so again, that's another publication we put out that tries to show how our thinking through different slices of the data and different pieces of the Canadian or different household groups within the Canadian economy are, what challenges they're facing and then how things might impact them. So hopefully that does help people understand that, again, we are looking at what's happening. It helps us understand the economy. But yes, in the end, we are aiming for CPI, national inflation rate, and pulling it to 2%.
Well, great. Thank you so much, Sharon, for these insightful remarks. You're strongly out of the gate here with this first speech. So thank you so much for doing it with us. I got to say, I didn't know about the flower charts. So, we've been looking at spider web charts here, but I think the flower charts is a little bit more attractive. So I'll make sure to look at that.
It's got a lot of indicators.
Thank you so much for those remarks. I hope to see you in person soon. For the rest of the participants, we're going to take a 15 minutes break and we'll be back at 10:45 Pacific time. Thank you again, Sharon.
Thank you, Sylvain.